Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let mortgage market update. I hope you're keeping really well. Apologies for not being with you last week. As I mentioned on a previous episode, myself and my family had a few days in Wales. I had intended to do a video, but hadn't quite foreseen how weak the Wi-Fi was going to be, so uploading the videos would have just taken forever. So I'm afraid, apologies rather for not being here last week. Now the good news is that we have 2 weeks worth of catching up to do in terms of lender news. I'm not going to go through every single change that's happened in the previous week, but there are some really cool things that have come out that I really want to share with you. So we're going to go through our lender changes first of all, and I'm going to give you some up-to-date information on the property market. Okay, so let's start off with our lender changes over the last week or two, and there are quite a lot to get through, but all really positive. So first of all, Keystone have made some rate reductions by up to 20 basis points on what they class as their core range. They've also made some rate reductions on their larger loan range as well. They've also changed their lending policy, so they're now accepting HMOs of up to 10 bedrooms, was previously 8, and they've increased their maximum exposure limit to individuals or limited companies from 2 million up to 3 million pounds. Now, what they've also done is release their green mortgage offering, which means they're providing exclusive rates for properties with an EPC rating of A to C, which are 5 years or older. Now, these rates are going to be 15 basis points, so 0.15% below the core range, and have been designed to support the improvement of existing buy-to-let properties to help reduce carbon emissions and provide greener living for tenants. Now, also in addition to that, what Keystone will do is every time a mortgage completes, they're going to be planting a tree as well. So that's really cool. So well done, Keystone. Now, in terms of Keystone as a lender, they're very good. They are fine with lending to individuals or limited companies. They can get their heads around some relatively complicated limited company structures. They're very happy to lend to portfolio landlords. They're very good on those for those landlords who aren't showing a great deal of income as well. So lots of good bits of criteria which to kind of underpin this fantastic new offering that they've brought out. Now, we've also seen Shawbrook reduce their rates, and their buy-to-let rates on standard properties are now starting from 4.34%. And they also have 10-year fixed rates, which start from 4.59%. Now, on the kind of grander scheme of things, those rates are going to sound relatively expensive to you. But there's a very good reason why Shawbrook charge a bit more than, the other buy-to-let lenders. Now, first of all, Shawbrook are what is classed as a challenger bank. So they're more of a commercial lender who also does buy-to-lets. Now, because they are more commercially orientated, they really are geared up to lend on those more complex cases. So, for example, they can do really complicated limited company structures. They can do cross-charging on portfolios. So what that means is that you can have one single loan secured against multiple properties. In my experience, they take a really pragmatic approach to particularly smaller levels of adverse credit. They don't mind how many properties you've got in the background. They're happy to do things like flats over commercial, for example. They can also do mixed-use properties and full commercial as well. Now, recently they've changed their policy on valuations, so they are able to do AVMs within certain parameters. They can do day one remortgages against market value, and they really don't get hung up on this whole thing that some lenders don't like, which is the freehold leasehold exposure. So if you're a landlord and you have a block of flats and each flat is on a leasehold and you own all of the leases, but you also have control of the freehold, either because it's in a slightly different name, so you and your partner, or you own the limited company that owns the freehold, but fundamentally you can control it. They don't mind that. So they're a really flexible lender there. Lending policy is really good, and it's great to see that they've brought some pricing down. Now, we've also seen Foundation Home Loans make some reductions to their rates, including their standard 5-year limited company rate, their HMO rate, and also their short-term letting product, which has been reduced by a full 0.5%. They've also introduced 2 new short-term let discounted rates, which come with no early repayment charges, and these rates start from 3.49%. They've also reduced their Green Rewards remortgage product, which has been reduced by 0.1% as well. So again, lots of really great repricing going on with Foundation Home Loans. Now, another piece of news that I was really pleased to see is that Kent Reliance have made a piece of amendment to their lending policy. So what they have done is they're now only requiring personal guarantees on limited applications from the company directors. They're not taking personal guarantees and therefore not underwriting any of the shareholders. So look, why is this important? So, okay, first of all, Kent Reliance used to have this piece of lending policy and then they removed it during COVID. So it's really fantastic they've brought it back into play. So who is it good for? So if you imagine you've got a limited company where the company directors are, for example, I don't know, husband and wife, and the shareholders, you've got husband, wife, children, other family members, etc., etc. That can essentially throw the application out from fitting with lots of different lenders, because the personal guarantees that the lenders would normally require, for example, couldn't be taken from children. Children can't legally contract. So the fact that they've brought this bit of policy back into play is really, really good. Another thing that this works really nicely for is if one of your shareholders is overseas. What you would normally find is if you have one of the applicants who is overseas, the lenders would treat the whole application as an expat mortgage, which is more expensive. Whereas because of this policy, as long as your directors are onshore, having an offshore shareholder means that the application fits with Kent Reliance. So really great to see them bring that bit of policy back in. That really, it really made my day when I saw that. Now, we've also seen the Ipswich Building Society announce they're going to be rebranding and they're going to be known going forward as the Suffolk Building Society. Now, the Ipswich are a lender who, they're fairly nichey. They're very good at, we would use them particularly for holiday lets. In the residential homeowner space, they're quite strong for those people who have complicated incomes, basically. So they're not a cheap clearing bank, Santander type lender in the resi space or indeed the buy-to-let space, but they do some really quirky stuff and they do it incredibly well. So that's where you'll hear their name come up. So from now on, if we start talking about the Suffolk Building Society, you know who we're talking about. Now, we've also seen TSB make some amendments to their lending policy. So first of all, they are increasing their maximum age for buy-to-let applications to 80, was previously 75. They're also amending their rental calculation. So going forwards, they're going to be using on less than 5-year fixed rates, a notional interest rate calculation of 5.5%, but on 5-year fixed rates, they're bringing it down to 4.5%. So the calculation would be 145% coverage, assuming a rate of 4.5% if you're taking a 5-year fix, which is great because what that means with TSB is you can just borrow more per pound of rental income on 5-year fixed rates than you could have done before this amendment. Now, TSB are a lender who play very much in the vanilla end of the market. They're lending to individuals. They want people with clean credit. They're not looking for people with portfolios of more than 10 properties. But what they do have is some really nice pieces of lending policy. TSB were originally part of the Lloyds Banking Group, so they kind of have a fairly similar approach in some regards to BM Solutions. And one of the things that I particularly like about them is their approach to property types, particularly unusual property types. So what you'll find is that their core list of things they do not accept is very, very small. It becomes very much down to valuer's comments. So a prime example of that would be a studio flat over, for example, commercial. So they won't instantly say, well, we just won't lend on this. But if the surveyor goes out and values the property and says, well, actually, because it's above a takeaway, there's lots of noise and there's a pub over the road, I really think resale on this would be very difficult. They're going to step away. But actually, if the surveyor comes out and says, yeah, do you know what? This is a studio, it's over commercial, but actually there's a huge demand for this kind of property in this area, then they're going to be able to continue to lend. So that's really good. So great to see TSB make some amendments to their policy. Now, Pepper have released a limited edition 5-year fixed rate, which is good for those clients who have no CCJs or defaults registered in the last 5 years. And the reason that's important to stipulate that is because Pepper do have a series of products which are designed for people with varying degrees of adverse credit. So the rate they brought out is for the cleaner applicants. The rates is starting from 3.18%. It's available to 75% loan to value. It's really not bad at all, and it's available for individuals as well as limited companies. So good to see them bring out a rate, which actually at 3.18% is pretty good. They've also made a couple of changes to their lending policy. So they're now accepting let-to-buy applications. So a let-to-buy application would be putting a buy-to-let mortgage on the property which is currently your home, on the basis that you are then vacating that property and buying somewhere else to live, basically. Interestingly, we're definitely seeing an uptick of people doing let to buys at the moment. Whether it's a kind of the decision to do that is really kind of chain breaking because of the stamp duty holiday. People are looking to kind of expedite their purchases. That could be a reason. But actually, I also think because people are just kind of really geared up to the idea of actually investing in property at the moment, I think there's a real appetite to do this. And actually, by retaining the existing property and buying the new one, and keeping it on, that can really be the way people get onto the buy-to-let ladder. It's exactly what I did with my previous home, where I've just retained that and kept it on. So it's very popular. Now, the other kind of fashion, just on that note, that we're seeing is that people are keeping their existing homes on as buy-to-lets, but what they're actually doing is selling those to a limited company. And then buying their new home in their personal name. And there's various reasons which largely sit around tax, the stamp duty and income tax, which is why it's beneficial to do this. So if you do find yourself in that situation, just give us a call and we can chat it through. But great to see that TSB are now allowing let to buys. They've also reduced their minimum income requirement. Sorry, this is Pepper, not TSB. There's that many lenders, I'm getting myself confused. They've also reduced their minimum income requirement on buy-to-lets from £30,000 down to just £18,000 now, so that's really good news. Okay, what else? We've seen some rate reductions from Kensington. They've brought out a couple of limited edition products, which are very competitive. These apply to both limited companies and individuals, and they have limited edition rates for both standard properties and HMOs and multi-units. Kensington, they're a good lender. They used to have a real stigma attached to them because they were largely regarded as a lender who you go to when there was pretty significant adverse credit on people's files. They've really moved away from that now, and they are kind of a lender who's looking for much more clean credit profiles from their borrowers. But actually what they do is really quite nice. They've got some niche pieces of lending policy. We do like them. I can't say we use them a huge amount for no particular reason, that their pricing isn't normally sort of good enough to kind of warrant it, but it's great to see that they're making inroads to sort of join in with the rest of the market. Now, lastly, we've seen Platform Home Loans release a couple of new buy-to-let rates, starting from 1.49%, which are very, very competitive. Again, Platform Home Loans, a bit like TSB, very, very good lender, very much operating in the vanilla end of the market. So they don't want people with large portfolios. They want you to have income which is separate from your property income. They want clean credit, they want straightforward properties, but actually, that applies to lots of our clients. So if you are in the market for particularly a remortgage at the moment, Platform have got some really, really good rates. Another piece of news that I've quite liked seeing is that we have seen TSB introduce a new green further advanced mortgage range, which is designed to help their borrowers improve the energy efficiency of their property. So you're able to borrow up to £15,000 to make green improvements to your property, and there are 2 and 5 year fixed rate options available. The rate is incredible. It's a flat rate of 1.49%, and there are no arrangement fees with this. So if you are a TMW borrower, you want to make some property amendments to your property to improve the energy efficiency of it, this is a really great solution and very, very cost effective way of borrowing the funds to do so. Now, last couple of bits of lender news for you this week. So first of all, we have seen Landbay make some rate reductions on their non-portfolio products. Now, non-portfolio would be for landlords with less than 4 buy-to-let properties, not in a limited company. So their 5 year fixed rates are now starting from 3.39%. They've also reduced their minimum property value that they'll accept down to a very, very good £65,000. In the limited company space particularly, we do struggle with lenders wanting properties that are valued at below £75,000. So it's really great to see Landbay come in here and drop their minimum property value down. This is particularly poignant for those borrowers who are looking to invest. I don't want to stereotype here, but particularly in the north of the country where you can access those kind of lower value properties, which are so popular with investors because the yields on them are just incredible. So well done, Landbay. They're also now considering properties above commercial units at up to 75% loan to value. So previously they had a loan to value limit of, I want to say 65% on those. Again, I think it's going to be very much subject to valuers' comments as to whether they would want to lend on it. So if the commercial property would actually affect the resaleability or the rentability of the property, they're probably not going to lend. But actually, if the commercial property makes no odds to the ability to let or sell the property on, then they're going to be happy to go ahead at 75% loan to value. Now, I keep saying last, but it's not last at all. I've got a couple more still for you. So Fleet Mortgages have made some changes to their criteria. So first of all, where we have a person looking to borrow on a leasehold property, but they also have control of the freehold, they're no longer looking to take a charge on the freehold of the building. They're happy just to take their charge on the actual lease only. They've also reduced the minimum acceptable size of a studio flat down from 35 square metres to 30 square metres in what they call urban areas. Now that's a really good bit of lending policy change actually, because we do struggle with flats that are less, or studio flats, that are less than 35 square metres. So great that they've kind of seen a gap in the market there and leapt in to help plug it. Now they've also changed their exposure limit. So what they're now saying is if there is a block of 4 flats or less, they can consider lending on every single flat, so all 4 of them. If the block has 5 or more flats, they'll still lend against 2 or 20%. They've also just changed a bit of requirements with regards to the paperwork that they ask for from the, or as part of the mortgage application process. They're streamlining things for non-portfolio landlords. So really good to see Fleet Mortgages are really looking at their offering and looking to make some really good changes. Now this really is our last update now. So Landbay have now started accepting holiday let applications. What they're saying is that they're not going to accept any unusual construction types, anything with restrictive occupancy or any park homes. They can lend from between £50,000 to £1 million, and the clients have to already be a landlord to be able to access their mortgages. They're happy to lend to limited companies, trading companies, partnerships and also individuals. They do have a minimum income requirement of £30,000. Now here's the bit that I found really interesting. So in regards to calculating how much you can borrow, so what they're saying is that they're going to use the holiday let income rather than a notional AST income, which a lot of the lenders do actually do. So that's really good because that really helps numbers, particularly, and I know we've talked about this before, for those properties where it's they're fantastic. The properties are quite expensive. They yield incredibly well on a holiday let basis, but actually if you were to rent them on an AST, you simply wouldn't get the right level of income to be able to support the borrowing that you're looking for. So it's great they're doing that. So what they're saying is their rental calculation is based on a letting period of 30 weeks a year at an average of the low, mid and high season rates. So yeah, definitely really good news from Landbay. And that is it now. So lots and lots of lender news, which has spanned largely 2 weeks, but I hope you found that useful. Okay, so just wrapping things up with a little bit of housing market data for you. So recently the Halifax have released their latest house price index, which shows us that on a monthly basis house prices in March were 1.1% higher than they were in February. House prices were 6.5% higher in March this year than they were in March 2020. So some key data for you here. So the average house price now, according to the Halifax House Price Index, sit at 254,606. That represents a monthly change of plus 1.1%, a quarterly change of plus 0.3%, and an annual change of plus 6.5%. There's also been some data released with regards to housing activity, where HMRC monthly properties and transactions data for UK home sales increased in February 2021 to its highest level since March 2007. Demand from home buyers for conveyancing quotes was 101% higher at the end of March than the average for the same period for over the previous 4 years. And that's according to data from Really Moving. So what do we take from this? Well, basically, the housing market is still going absolutely great guns. And we don't expect that to really calm down with the stamp duty holiday still going on. I think there's going to be a spike in activity over the coming few weeks as people try and nick in there before the stamp duty holiday ends. And I think things are going to really quieten down over the summer period, with business really starting to, or people's transactions really starting to regain momentum in the autumn. And I think that's been really underpinned by the government's new 95% mortgage scheme that's been released. So hopefully we're going to see things hold absolutely firm for the rest of this year. And that is everything from us this week. Sorry it was such a bumper week for lender news. That will serve me right for having a week off. But like I say, I think that actually everything that was reported this week was really interesting and relevant. So definitely worth investing some time to catch you up on it nonetheless. So look, as always, do give us a call if you have any questions, 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. This time next week, our office will be reopened. We're starting to open our doors to our staff from Monday. We've all been having the delightful COVID test this week to make sure we're fit, and we'll be doing that going forwards. But I think I'm still going to be recording this video from home because I'm on the sort of shift pattern that I'm working. Wednesday mornings are Wednesdays are one of the days that I'm going to be working from home, so you may not see the office, but I might surprise you. You never know. But look, until next week, do look after yourselves, have a great weekend, and I will catch you next time.